Welcome to Noble Gold's Investments Inflation Series. And in the first part, we define inflation. Now let's talk about the different causes of inflation. The increase of money supply without matching the increase in supply of goods is the root of inflation. From these, there are different ways it could play out. We have demand pull inflation, cost pull inflation, and built-in inflation. First, let's talk about demand pull effect. This is when an increase in the supplies of money and credit causes the increase in demand for goods and services. However, the production of goods and services aren't able to keep up with the demand. Basics of economy says less supply but more demand leads to a price increase. When the Fed kept the interest rate to zero and pumped more money in the economy, people felt a little bit more positive and they started spending again. When the Fed wasn't able to do what people asked to do, and they weren't able to come back to work and produce more of the goods and services, the result was higher prices. The second cause of inflation is the cost push effect. Cost push inflation is when the increased cost of goods works its way to the production of goods. When prices of goods, wages, and other raw materials increase, and there are no suitable alternatives, then the price of the end product increases too. As an example, if something happens to countries that supply us with oil and other raw materials we use for commodities, it creates a speculative boom in oil prices. This will then result in the increase of the cost of energy, which in turn contributes to rising consumer prices and is eventually reflected in various measures of inflation. For example, and I hope this doesn't happen, if, let's say, some natural disaster like a typhoon or tsunami hits major oil suppliers, the cost of oil per barrel will increase. If the price increases but your earnings don't, then you have less power to buy oil. That causes inflation. Last is built-in inflation. Built-in inflation is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. As the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs or wages to maintain their standard of living. It makes sense. Their increased wages result in a higher cost of goods and services, and this wage price spiral continues as one factor induces the other and vice versa. And there are the three major causes of inflation. Do note, none of these causes is mutually exclusive. Often these happen collectively. Now that we know the different causes of inflation, let's look at different ways inflation is measured. Let's check out the next part of the series.